We'll get started. Thank you for joining us. We are, this is the last webinar of 2021 for Opus Connect. And if you're quite engaged with us, you know it's been a long year. So excited to have you and excited to end the year on hopefully a high note with some good information for you all as we start to see some of these year-end tax changes. So before we get to that, a few housekeeping things. For those of you I have not yet had the opportunity to meet, my name is Lena Dobrier. I'm the Director of Operations at Opus Connect. We are a lower middle and middle market M&A focused organization, membership based. We do about 350 events a year. Since COVID, those have been virtual, but we've started kind of introducing a hybrid. So we'll be doing in-person events next year, and as well as keeping the virtual, depending on how the news progresses and where we find ourselves in COVID. A bunch of different formats. Many of you are participating in today's Deal Connect, Middle Market Deal Connect, where we pair up capital providers and investment bankers for one-on-one meetings. We do webinars, lunches for six, etc. So if you're interested in learning a bit more about who we are, how we can help, please reach out to my colleague, Swayze Yancey. His contact information is there on the screen, or feel free to reach out to anyone on the Opus team. We'll be happy to answer your questions. During today's event, we will be taking live Q&A. Whether or not we weave that in immediately or at the end, our moderators will decide. But as questions come to mind, feel free to submit those in the Q&A bubble at the bottom of your screen. I will ask that you please avoid the chat function. We will not be monitoring that. But go ahead and submit your questions in the Q&A, and we'll try to get to as many as possible. I want to give a quick shout out to one of today's sponsors, David Kogan of Sapient Investigations. I don't believe he's in the room, but David Kogan has been with us since the beginning, longer than I've been here, if you can imagine, for those of you who know me. Corporate intelligence, works with a lot of private equity firms, helping to source, vet C-level executives, etc. So if you're interested in David's services or how he can support your business needs, please reach out to him directly. And then, of course, today, Plante Moran, we have two gentlemen on the call, Don and Zachary, that are going to be leading the discussion. So I'll wait until we introduce them as our speakers for them to give a little bit more color on Plante Moran. But Plante Moran has been supporting us for a while now, and we're grateful for their continued partnership. And I wanted to acknowledge them there. We do have one poll question that I'd like to ask, but as these things happen, I'm struggling a bit with pulling it up. So we're actually going to skip that in real time. Thank you for playing. This gives us a better idea of who you are and how it breaks down into the audience, but we know that many of you are private equity firms and investment bankers and lenders and owners and operators looking to get the information. So without further ado, I will exit the building, if you will, and introduce our speakers today, Don Stanovcak and Zachary Youseff of Plante Moran. Gentlemen, the floor is yours.
Great, thank you so much. Yes, this is today's life, right? Live and in person on Zoom, and things happen like live television almost. So we're going to be flexible with the Q&A as things come in, and any comments you have in there or questions you want answered. We're open to having those discussions as we go along. So I'm Don. You'll hear from Zach in a moment. Both of us are in the transaction advisory services group for Plante Moran on the tax side. So what's that mean? As I'm sure most of you are familiar, it's mostly due diligence, transaction structuring, modeling, but ultimately, we see ourselves as an extension of our clients, our private equity clients, and just helping them get the deal through, right? I mean, at the end of the day, that's what we're all here for. Try to get a deal from point A to point B and closed as efficiently as possible. So whatever that calls for us to do to help out with, that's what our role is. So we try not to pigeonhole ourselves too narrowly into we're just due diligence or we just do modeling or structuring. It's really whatever the job calls for to make sure that our clients are getting the service they need to make sure they're meeting their goals. So been doing it for quite a while now, about 10 years in for myself, and I'll let Zach maybe give a little bit more background on himself too for a moment here.
Yeah, close to coming in on 10 years as well. And I think that was a perfect overview, Don. I think, like the rest of the audience, I'm sure we're all, we're deal junkies to a sense. We love deals, love the deal world, love the people it attaches us to, and the mission of what we're trying to achieve here. So, excited to be here today and look forward to getting into some fun tax legislation items.
Yeah, what better discussion is there than on a above average temperature, but a little windy day here in Cleveland, Ohio for Zach
I'm
and I.
sorry, Don, to interrupt. We're getting some background noise, and I want to ensure that I'm not the only one hearing that. I just saw that Zachary muted some.
Yeah, you did sound a little bit muffled there, Don. Maybe it's the wind.
Could be. Is it any better now?
It's actually not.
Okay.
And Zachary, you're hearing that as well, correct?
Yeah.
It just happened. Maybe mute and unmute yourself. Sorry for the technical difficulties all, but these things happen.
How's this? Any better?
Not really, unfortunately.
Okay. Maybe unplug and plug in or something. Your aux. I don't know.
Sure.
And then Phoebe, why don't we navigate to the overview of today's discussion from the slides that Plante Moran put together, and maybe Zachary can give us a little color while Don gets resituated here.
Yeah, absolutely. So today we're talking about current tax legislation, and what we're specifically talking about is the Build Back Better Act. Any better, Don?
How do I sound?
Much better.
Crystal clear.
Crystal clear. Great. The old unplug, plug it back in. Right. That's the magic here. So again, we're here today to talk, as Zach was just getting to talk about the Build Back Better Act. Gets a lot of press, and we've been along for the journey for quite some time here, just seeing how this thing's going to unfold. What we want to talk about with you today is just maybe a legislative update, where we are, a little bit how we got here, not spending too much time focusing on the past, but where we are. What does it do for the folks here in this audience, and what are some things we need to be thinking about? And then finally, the BBBA gets a lot of press, but there's also some other tax changes that are just happening as a matter of course that we want to keep our eyes on as well. So that's kind of our overall guidelines here, what we're going to cover. As you'll see, there's a lot more detail to it than just that. We're going to cover maybe the technical parts of it, but I think mostly what we're going to focus on is what's the impact, and what are some real life impacts that we're seeing in the market as this unfolds in real time. So if we move on to that first maybe content slide here after it, where are we in the process? Well, obviously it's not done, right? So the Biden administration came out very early on and came up with some proposed frameworks about what tax legislation was going to look like, and those got massaged in a way and all the way to the House of Reps about September, middle of September. From that time, though, from the framework that Biden announced to the time the initial bill got drafted, there was a lot of conjecture, and I think the overarching comments were tax rate increase, right? Rate increases, people were going to pay more tax, and a lot of that was tied to the spending bill, right? So this is just a balancing act. If the spending bill is high, needs more revenue raisers, so more tax, right? And so there's going to be accomplished in a variety of ways, and through tax rates, limitations on deductions, maybe removal of some favorable programs and deductions that were in existence currently, and maybe early sunsetting those. So that's where we started. And it was if I recall, it was about a $3.5 trillion spending bill that was initially proposed. Since that time to now, the spending bill came down to about $1.75 trillion. So because the spending bill came down, now the revenue raisers didn't have to be as high. So from early March when they first started talking about these changes to where we are today, where we're waiting on the Senate to pass something. The bills changed dramatically. But more specifically in the Senate, are we going to get something passed now before the end of the year, January? It feels a little up in the air right now. I will say that just recently, Senator Schumer came out and said that he wrote a letter to some of his Democratic colleagues and said they still wanted to get something passed before Christmas. Well, and that's fine, and that's possible if there aren't a lot of changes by the Senate to the bill. If there are a lot of changes by the Senate to the bill, then what happens is that it needs to likely get rescored. So it's got to go to the scoring committee to determine whether or not the changes are going to balance again with the spending, or if they change too much to potentially not generate enough revenue to cover the spending. So to the extent they keep it similar, the same, it's already been scored to, I think, at a point where it's close enough for the ability to be passed. So it would be a quick passage if they didn't change anything and send it to President Biden for signature. So that's kind of where we're at right now. Zach, I don't know if you have any additional comments.
Yeah, just for guys like us, it's almost becoming a reoccurring year-end saga. As consistent as a holiday Hallmark movie on what gets done before year-end or after year-end. And so, I think bigger picture, we don't have that crystal ball. I think we're far along in the process where it's pretty certain there is going to be legislation changes. However, pre or post year end is still up in the air.
Yeah, if we flip to the next slide, this kind of talks about some of those other current challenges. So we got to get consensus in the Senate, which sounds like an easy thing, but it's, especially because they really don't need Republican action as part of this. This is essentially all on the Democrat side. So it seems like they would all be on the same page, but it's furthest thing from the truth right now. Not a lot of time left either in 2021. Every day that goes by becomes more likely that this thing's going to slip into January. And they've got other things on their plate too, with debt ceiling, annual defense, spending bills, government funding. So it's not just one item for them to focus on here in the waning weeks of 2021. So I know I hinted on it earlier, but if we flip to the next slide, this kind of gives us a little bit of a matrix on what's in versus what's out. And we'll cover a lot of these in more detail as we go through the presentation. But this provides a nice visual in terms of really the how things are falling right now. Currently in, maybe some of the more noteworthy ones we'll talk about later is this tax surcharge. This is new. It's a new tax rate thing for high income earners. NIIT, this closes the gap on a lot of our pass-through owners that were not previously being charged a 3.8 either through self-employment tax or NIIT. Kind of puts everybody on an even playing field where everyone's going to get hit with 3.8 over a certain income threshold. The SALT cap gets a lot of press, right? I mean, this is one that it's not too hard to find opinions on it. The last we heard about how this was moved. So currently it's a $10,000 SALT cap on your 1040, right? If you pay tax over state and local tax over $10,000, you don't get the benefit for it on your itemized deductions. Now, currently they're talking about increasing that to $80,000. And there's a lot of interesting nuances to how this applies, and do they raise the cap, but then schedule it back down once you get over a threshold, income threshold, to where now the high income earners aren't getting a benefit from it, and that's really the balancing act that's going on in the Democrats right now. Is you've got a pool of Democrats that want to make sure that high income earners aren't going to benefit from any adjustments to the bill. Whereas you got folks on the other side where they're saying, yeah, but a lot of our Democratic constituents live in high income tax jurisdictions. So we need a little bit more of a salt cap to help those folks out. And there's this battle here about what the salt cap's going to look like, and where it ultimately falls will be certainly interesting. And maybe just to then talk about some of the key items that are currently out. So currently out, most notably maybe is individual tax rate increases. So originally, President Biden's proposals were reverting the income tax rates back to 39.6% pre-tax reform in 2017. That's not currently in the bill, so they're going to stay the same. QBID, the qualified business income deduction, which is applicable for a lot of our pass-through entities for our clients, was also going to change to maybe potentially be less impactful. And finally, the corporate tax, right? Corporate tax was scheduled to go up potentially to 28%. Originally, maybe it was all the way up to 35%. Now it's back at what it is now, currently at 21%, but there is this new alternative minimum tax for very large corporations, which we'll talk about in a minute here. So effective dates is another key part of this, right? So it's one thing to talk about what's changing. It's another part to talk about when is it going to change, because that definitely plays into the world we live in with transactions. Is it something that we're already in and we can't avoid, or is there something we can do over the next 2 weeks to potentially plan around it? And the proposed effective dates change, and it has a lot to do with how they're reported. So the salt cap enhancement, potentially up to $80,000, would be retroactive to the first of the current year, 2021. Whereas things like NIIT expansion and the tax surcharge, which are effective rate increases for individuals over certain thresholds, wouldn't go into effect until 1/1 of 2022. So there is still this window here that someone could avoid the impacts of the surcharge or the NIIT expansion if they were to complete a transaction here in this year. And some of the further ones that we won't spend a ton of time on today, that are set to change 2023 and beyond are modifications to business interest expense would probably be one that would be important to this group. Okay, so moving on to the next slide here. We talked about this already, right? So there's still continues to be some movement here in the Senate, and we'll continue to keep our eyes open to anything that actually shakes out. But I think the key here is identifying what opportunities are there. Now, are you going to be able to open and close a transaction in the next 14 days? No, unlikely, right? So. But are there some that are maybe on the bubble of either being just in the nick of time this year versus early next year that maybe you might try to influence one way or another to help fall into one of these rules or out of one of these rules? Yeah, I think that's well on the table. And anytime we talk about adding additional tax, and whether through this NIIT expansion or the surcharge, folks that are going to fall in those ranges, you start getting into the similar conversations that you have anytime there's a tax rate change. So is it rates are going up? Is there a way to accelerate income this year and push deductions next year? So a lot of those same principles still apply here, and they're simple on their face, a little more complex to get done. But that's the overarching message here: is nothing's been finalized yet. We think we know where things are going to fall out. Is there planning to be done? Yes, there's still a little bit of time to get some planning done. And on the last slide here, again, we covered some of these points just a slide ago. Most notably on this is the question we get is, well, what are the chances something comes back in? With the time we have right now, it's probably gonna be hard to add stuff back in that's fallen out. So one item that we were getting a lot of questions on is like the carried interest rules, and something like that's that complex to get applied and executed makes it difficult to get it back in at this point when they're trying to get something passed in short term. So I think we have maybe the population of what might be in the bill. It's maybe just parts of the details that we don't just quite have yet.
Yep, I just think of the 80-20 rule, kind of bell curve here. It's got almost all that's going to have in it, and it's going to take a little time here to get past that 20% and really get it passed.
Yep. So Zach, do you want to take us through maybe some individual tax changes here?
Absolutely. Let's jump into it. So we'll first hit here on individual tax changes. And so let's maybe level set, kind of start from the lens of how that impacts and applies in the deal world. And that's, again, the lens we'll talk about things here is really, how does this impact deals? And what we see is the two proposed changes, one being a new tax altogether, which is the surcharge, and the second being an expansion of a current tax, the net investment income tax. They'll both have direct implications on deals. And when I think of the individual side, in the world we live in, I generally think of the seller. And so when having this big capital event, these two taxes can certainly be relevant. And what we'll see here is they kick in at higher income levels. So with that, we'll first talk about the tax surcharge. And this is a new tax altogether. So let's actually flip back to the last slide just quickly here. So big picture, this surcharge is a tiered tax that's going to kick in at a 5% surcharge on a taxpayer's modified adjusted gross income in excess of 10 million, and then an additional surcharge of 3% over 25 million. And so big picture thing to point out here is it's on a modified adjusted gross income, which really means two things. One, it includes all sources of income, both capital and ordinary income. And the second is because being modified adjusted gross income, there can be offsetting loss opportunities at the individual level or other certain tax shields that they may be able to utilize to offset and be below these thresholds. And with it being a tiered threshold tax, the name of the game from a planning perspective is to figure out how to get and stay below those thresholds to the extent possible. So with that, let's flip to the next slide, which is just a little outline to give you an idea of what a kind of a combined tax rate may be under the current kind of proposed tax surcharge. So what we see here is kind of look to the far right two columns. That's where the surcharge kicks in. Once you're above that $10 million to 25 million, it's going to be a 5% rate, and then in excess of 25 would be an 8% rate. So again, let's think about, well, how does that apply to an exit? So an exit is generally going to be capital gain rate of 20%, surcharge, then now 8% if you're all the way above 25 million. So you could have up to a 28% combined long-term capital gain rate if you're all the way in that $25 million threshold. So let's continue on to the next slide here. So, again, what's the planning items here? Again, it's how do we stay below these thresholds? And when we think about that in an exit, could there be now kind of proposed economic changes to terms that could potentially kind of net be a winner for the buyer and the seller? So if the seller is getting an exit and they're going to absolutely have a significant gain, could we spread out that gain over multiple years? Would deferred payments or different tranches of exits over time be an opportunity where the seller now is saving and avoiding that surcharge tax? And then from a buyer perspective, from a present value of not having to pay deferring payment until later, it's usually always a win-win. So that's really the big picture name of the game when it comes to the surcharge. And the key takeaways here is that kicks in at these higher adjusted rate thresholds of 10 million into 25 million. And if you can stay below that, you can avoid it entirely.
Yeah, Zach,
All right.
this is another interesting one too, and it probably goes along with the NIIT as well, is just, this is one where we're hearing sellers coming back to buyers and talking about how the surcharge is going to impact them 1/1. So it's important for them to get closed this year. So it'd be interesting to see what the market's kind of response to that is, and does it then come down to like who, was anyone the cause of the delay, or was it just general items that come along with any deal? So, but I hear you on like in terms of like maybe setting up some installment sale planning, and I think this is all just about management and how do we try to manage expectations and manage income to potentially work with these rules.
Absolutely. So that's the new tax imposed on individuals. Next, we're going to talk about not a new tax, but an expanded proposed tax. So we want to flip to the next slide here. So this is the net investment income tax. And for those not as familiar, it in current legislation is a 3.8% tax on a individual's passive income. And what the big proposal of the expansion of the net investment income tax is that it will be on all sources of income, passive and non-passive. So without getting in the weeds, what we're kind of seeing is, if we think about it, we have an active owner that it may be active and thus can avoid this net investment income tax, could potentially no longer avoid it even as an active owner, as well as kind of structuring considerations, being whether you sell and generate 1231 gain versus capital gain, and how that plays into all of it. And so we'll avoid getting deep into the weeds. But what we see with this tax is it's again expanding onto active sources of income. So with the caveat there is then that you net it against self-employment. So this is one again where it's more narrowed structuring than just a new tax. It's really expanding the tentacles of this net investment income tax, and so there's certainly some modeling and planning to consider with this one. So if you want to flip to the next slide. Again, I think we hit on most of these, but I'd say key takeaways to think about here is one, think about just during a holding period, and maybe this is more on the buyer holding period, where an individual was active and certain structure was put in place to allow them to be active and avoid the net investment tax. The current law, those might need to be reassessed and maybe even unwound. And that needs to be balanced again against a situation where the individual's also subject to self-employment tax. So it's really kind of balancing the two against each other. So again, this one is not as clean cut as keep your adjusted gross income below X threshold. There's definitely some deeper planning to consider with it.
Yeah, the one that really is interesting to me is that impact to gross up payments too, and how if you're targeting that S corp, previously the 3.8% would only apply on the sale of the stock side of it. So if you're comparing in a gross up your after tax proceeds between selling stock and selling assets, an active S corp owner would only be subjected to the 3.8% on the sale of the stock. So the difference between a stock sale and an asset sale would be smaller because you got higher rates on the stock sale, and then that rate's not inside the asset sale. Well, now that same S corp owner may be subjected to a 3.8% on the asset sale side of things, it increases the rate arbitrage between the stock sale and the asset sale, which economically makes a difference. It's going to increase a gross up payment on a transaction that closes today versus a transaction that closes a month from now. And how does that economic impact? Well, depending on the size of the gross up, it could impact return investment calc for private equity and how the fund's doing and how investments are doing and the returns that are getting, because that's purchase price. That's a true economic purchase price difference that's caused by this that is impactful in a variety of ways.
Absolutely. And on that theme, let's flip to the next slide here and kind of apply some numbers to it. So again, this would be with the surcharge layered in and the net investment income tax. And what we see is kind of to the far right column is a scenario where could be as high as 31.8% on that income above 25 million. And so if we take a step back and level set, again, the broader thesis here is that the BBBA Act is less impactful. But when we kind of compile it with the right facts and circumstances, we can see that could be quite a spread, right? So it could be looking at that 31.8% in comparing to current legislation, the spread could be all the way to 10, 15% under today's current rate. So there's certainly that spread and that how that economic impact hits and who pays for it. Again, I think it's just something that we'll have to see play out in the deal world. So with that, I'm going to turn it over to Don here, and he's going to lead us through some of the corporate impacts.
Yeah. I think we did cover the items on the next slide. So we skip a couple ahead.
Don, sorry, your mic again is
okay,
going in and out. We might have to try the old unplug, plug it back in method.
Okay, good.
Perfect.
All right. So corporate tax proposals, again, scaled down from what they originally came out to be in the initial drafts. We're talking about 28%, probably more realistically on the proposal side, and that's come down to 21% now. The BBBA current version does create this new 15% corporate minimum tax. Now, pretty narrow application here in terms of quantity of companies that this likely applies to, because in order to have it triggered, the company's got to have over $1 billion in average annual financial statement income over a 3-year period. So not many companies are going to fall into that threshold. If they do, then it's certainly impactful. However, maybe something that's more attainable is the threshold that relates to reporting groups, international reporting groups, to where maybe the entire group exceeds the threshold, and you have a U.S. subsidiary that's greater than 100 million in book income. So it reduces the U.S. Companies threshold quite a bit to where this minimum tax may become applicable. But again, now you're talking about an international reporting group that is very large as well. So again, narrowed down the application here quite a bit, where it's not going to impact middle market as much as we thought that it was going to when the first proposals came out.
Absolutely, and this kind of minimum 15% tax, I think, goes after the Amazon and Apple stories of their tax rate being 0. It really kind of puts a minimum on that and says you're going to pay some level of tax. Is really what I think this one's going after.
Absolutely, yeah. That kind of goes along with the trend or the communicated trend of this really going after high income individuals and large companies. The next slide talks about a couple other corporate changes again. maybe a little bit narrower, but there's a 1% excise tax on the redemption of stock for publicly traded corps. It applies at the fair market value level. So again, not widely applicable in the middle market here. But there are some excessive compensation deduction rule changes that, again, depending on the size of the company, is probably going to be more impactful or less impactful, just depending on what that size is. So we're keeping our eyes on how those details flush out. But again, in most of the middle market companies that we're dealing with on a day-to-day basis, this isn't causing a lot of concern. So I know we touched on salt cap a little bit earlier. We gave a little bit of a preview, but Zach, I know you had some other details that you wanted to touch on too.
Absolutely. Let's get into the saga that is salt cap. So to level set here, prior to the 2017 Tax Cuts and Jobs Act, there was no limitation on the amount of state and local taxes that an individual paid that could be deducted on their federal return. So I think that the big theme to note here is it's a limitation on what an individual can deduct on their federal return, but it's driven by their state and local tax expenses and deductions, and that would include state and local income taxes as well as real estate property taxes. So kind of with that premise, what we see with the passing of the 2017 Tax Cuts and Jobs Act is pretty much kind of this federal bill coming out and saying you can only deduct up to $10,000 in total state and local taxes that are paid. So we think about, New York, for example, these higher income tax rate states. An individual that works and that lives in New York certainly is going to be paying some combination of taxes, likely well in excess of $10,000. And that used to be something that, they could deduct and receive a tax benefit of, that they're no longer receiving that deduction. And so, again, maybe even takes further step back, we kind of see, taxes doing two things, right? They're revenue raisers for governments, both federal and state governments. And then they incentivize individuals' behavior. And so a lot of what we see here is this combination and this tug of war where a federal bill came out, a federal law legislation was passed that impacts the state's revenue. And as a byproduct of that, it even impacts, its total population and tax base, where we hear the stories all too common of people moving from New York per se down to Florida per se, where there is no income tax rates. And so that's where these states are really passionate about trying to circumvent and really kind of shouting to the rooftops that this is really impacting us as a local and state jurisdiction in our total kind of commerce that is really bigger than the impact of what can be modeled out in the tax bill. So that's where it's a really juicy area, and one where it continues to kind of be massaged, and there's a lot of back and forth on. So what we see at the BBBA Act is some level of relief in that it would increase limitation from 10,000 to 80,000. Which again, I think is some level of relief. The other kind of level of relief is really Notice 2020-75, and that it is already it's already issued, and not necessarily attached to the BBBA Act, but it's worth to note because it is kind of again additional relief where individuals that are receiving income through a partnership or S corp pass-through entity are allowed to treat that as non-separately stated tax delinquent. So what does that mean in general terms? It now enables states to allow an election to where if the taxpayer's income is coming through a pass-through entity and i.e. receiving it on a K-1, then that income and election can be made where the tax associated with that income is eligible for a deduction. So there is some level of relief there. Where this all kind of finally plays out will certainly be interesting. Could it go back all the way to a place eventually where the cap's completely removed? Certainly not sure. What the BBBA Act, proposes is certainly some level of relief that I think helps kind of relieve it and provides a little bit more peace maybe between these certain states and the overall passing of the bill.
Yeah, Zach, I think the pass through, and if we flip to the next slide here, the pass through credit is really interesting. I mean, it's because every state's got a different way that they're approaching this pass through entity tax credit, and they're passing them in different times too. So some are already effective, some are effective 1/1 of 2022. So I mean, we're all over the board here. California, for instance, has one that they allow, but they don't allow the credit that you get from paying it at the entity level to reduce the individuals. California tax below the minimum tax in California, the individual minimum tax. So there's all kind of rules. There's all some have guardrails around them, some don't. And it really comes down to on a state by state basis. But what's really complicated in all this is, again, not to get back into talking about gross ups, but this is a gross up concern again. So is the seller making the election? Are they not making the election? Are they getting a full offset credit? Or are they not getting a full offset credit? It can swing a gross up from $1 million gross up to zero, depending on the right facts. And vice versa too. If you get into a bad tax situation with like a state like California, where you could be paying more tax. So it's really interesting. It's really complicated. There's little to no guidance out there beyond some of just the language and the legislation that the states have passed. We're all trying to get our arms around it. I think the takeaway here is just awareness. And continuing to evaluate how these positions may or may not impact a deal.
Yeah, it fits in everything else as just an additional variable, to consider, right? So we have plenty of experienced, intelligent advisors, I'm sure, on the line, and as sellers get ready for exit, strategically, perhaps they no longer reside in a higher income state.
Right.
And so when we're now kind of thinking stock versus asset, it's again just an additional nuance to add in to the overall analysis.
Yeah, and I think to take it out of the deal space too, like post close, as you're looking at your platforms and your portfolio companies, this is impactful there too, because instead of passing through state tax deductions or state taxable income for folks to pay state tax at their individual level and potentially be capped by 10,000 or even 80,000, does it make sense from a cash flow perspective for your investors to elect into these credit mechanisms and potentially get a federal tax deduction that reduces the federal ordinary income tax federal ordinary income that's being taxed at the individual level. So this isn't necessarily just a gross up item. This is a portfolio company item. This is something that's widespread and wide reaching.
Yep. And entertaining from our perspective. I always laugh at this one, especially because Tax Cuts and Jobs Act, one of the stated goals was to simplify the tax code. And this is about the exact opposite of simplification. So with that, why don't we kick it over to talk a little bit about 1202, Don?
Yeah, 1202 is a great topic here. And just from overall introduction of 1202, what does it say? Well, in general, what 1202 would say, or some folks refer to a qualified small business stock, is you have the opportunity to exclude gain on the sale of qualified small business stock, so long as it meets the required thresholds at the point that you start and issue the qualified small business stock. You can exclude up to $10 million or 10 times basis in the stock, which could be a very big number. And it's the greater of those two too. So if you have a basis of $10 million, your exclusion could be $100 million. So it's really probably not talked about enough. It's a great opportunity. Currently, what it says is that you can exclude 100% of your gain so long as you're below those thresholds. What the BBBA is doing to potentially haircut that is saying, well, we're only going to allow you to exclude 50% of gain exclusion rather than 100%. And this applies for both estates and trusts. And again, you're looking at a certain threshold in which this kicks in. So it's currently slated to apply to transactions that are occurring on or after September 13th. So once it already occurred, this date's already occurred, and we're kind of in this window where you're probably subject to it if you didn't already take care of it previously. But I think the key here is that you can still evaluate maybe some exits that happened previously to see if they still would be applicable and potentially amend positions if this was overlooked prior. But overall, 50% gain exclusion is still a great benefit. So this isn't something that, oh, now that's 50%, maybe let's just take it off the table, let's don't even talk about it. It's like, no, like 50%, we're still talking about a fantastic opportunity here, and it should be continued to be explored. So on the next slide, we talk about just, again, a definition of, what is QSBS, qualified small business stock. Those are some of the requirements. So that it must be original issuance, and the tax base in the assets inside the company must be less than $50 million. Must be a qualified business. The non-qualified businesses are super narrow. So most of the companies we're seeing are qualified. And you have to hold it for 5 years. That's the key too. So it can't be a quick flip. It's got to be one that you're holding. So again, still a lot of opportunity, a lot of meat on the bone left here. Not something that you want to just completely can and not look at any longer. But again, there is a little bit of a haircut that they're trying to implement as part of the BBBA.
Yeah, absolutely. And this is the one I was probably the most surprised that made it into the BBBA Act, and looks like there was going to be a haircut on the overall benefit of it. And again, this kind of fits outside the thesis of kind of increased rates and tax for larger companies, because again, even the definition here, qualified small business stock, it doesn't fit in that thesis, but I think there's still tremendous value here. And I think where we initially saw this kind of being utilized with that kind of $50 million threshold is kind of in the startup world, especially venture capital world, where you certainly aren't going to have a significant amount of an asset base. And we saw that only continue to pick up as we kind of dove deeper into this, into really a lot of middle market private equity deals, based on kind of developments and structuring and working around these thresholds. So I think, yeah, absolutely. And the one thing about 1202 is, it doesn't complicate a transaction structure or its operating company generally. And so it's one of those where you don't need to do potentially a lot of crazy different things to get to qualify on the surface. So
yeah, absolutely. So we've got about 10 minutes left here, and we did want to try to leave a little bit of time at the end if there were any Q&A. But so we'll cover the next couple topics pretty quickly. So we move into this common control. This is again one that doesn't get a lot of press. One, because it's complicated, and two, not a lot of folks maybe know its impact. So common control rules are these widespread applicable rules that can kick you out of applying for, or kick you out of being able to apply for or obtain certain benefits, because now you're looking at a larger organization versus a narrow one company level. So to give you an example, if you've got a fund set up, and inside that fund you've got 3 platforms. Well, you may, under the existing common control rules, you may be able to disassociate or not combine gross receipts for specific programs in the current rules. So like a small business taxpayer election, for instance, you may be able to say, okay, we're going to look at just this platform here. They qualify. We can take the small business taxpayer rules rather than not. Now, with the expansion of these common control rules, you may not have that ability to create these silos. It may go up to a higher level, and now you're pulling in all of the attributes under that fund rather than just one platform. So now a company that may have existed and been able to qualify for small business taxpayer rules, now they don't. So now they've got to do 263A, or maybe they can't do cash method, or things along those lines. So it's really one that's kind of just lurking in the background, but it has some real impact. So if we move on to the next slide, there's some other changes that we hinted about before. So again, these are probably more administrative. We're not going to spend a ton of time on them, especially the 163J interest expense limitation. So calculating limitation at partner level versus partnership level. Again, these are just items that tax advisors and tax preparers are going to have to get into the weeds and determine how these flush through returns get presented. The research and experimentation expenses. The BBBA delays an effective date for a prior provision that was already enacted, where it was going to require capitalization and amortization of research and experimental costs over 5 years. So this is just, again, maybe helpful, right? Rather than having the ability to deduct them currently, this would have required an amortization of those costs. So it's delaying the enactment or applicable timeline for that amortization period. And finally, on this slide, we talk about excess business loss limitations. So some of these rules were made permanent. The 250 or 500,000 for single married filing jointly was scheduled to end at the end of 2026, and now it's permanent. And now it changes any carry forward of excess loss rules too. So again, these are more so items to just kind of keep your eyes open for. The excess business loss rules can be a little bit tricky in how they're applying now. And so I think the hope is this kind of clarifies and streamlines some of the reporting requirements or how they apply in a personal return setting.
And from there, Don, maybe we just kick it over to the sunsetting COVID programs and can open it up for questions.
Yeah, I think that's great.
So if we kind of flip through here to the next slide. So this is more for reference. We'll just quickly hit on these, which we think it is hopefully universally a good sign of coming out of COVID, is the sunsetting of various COVID programs. So again, this kind of can be used just for reference on how those are sunsetting here. On the next slide, I just want to touch on is the employee retention credit, and the thing that you make sure we flag here is just there remains opportunity. Oh, go back a slide. So again, that's sunsetting, and actually under the BBBA Act would be terminated even earlier here in the end of the third quarter of 2021. The point to flag is there still is amendment opportunities to go back in, and so always encourage folks, if they haven't taken a look at that in greater detail, it's worthwhile to take a dive into and potentially amend returns as warranted. So in the last slides we just added in is related to carried interest rules. Big picture, no legislative changes here, really just some more clarity and some actual reporting sheets on tax returns on how to report carried interest rules and those interests where that applies. So with that, I think leaves us a few minutes for Q&A.
If anyone has any questions for Don and Zach, go ahead and submit them in the Q&A now. I did send a notification a few minutes ago, but perhaps you missed it. If nobody has any questions, then we'll wrap up, but we'll give you about 30 seconds or so to frame them if you wish, and then we'll wrap things up for today.
Yep, that sounds great. Don and I's golden rule is we don't make people late for lunch. So on the East Coast, that could apply.
Well, thank you guys so much for today's presentation. I know that it was very helpful for a lot of people on the call. This webinar was recorded. It will be uploaded to our YouTube in the next 24 hours. So as soon as that link is live, we will circulate it with all of our attendees today. Don and Zach, I wanted to ask, because I'm sure I will get this question, is your PowerPoint available for distribution, or is that something internal?
Yeah, certainly we can package something up and send it out to anyone who wants it.
Okay, wonderful. So if you do want a version of today's presentation, please don't hesitate to reach out to Don or Zach. I have their contact information as well. So if you didn't grab it earlier, reach out to me and I will connect you directly. But again, I want to thank you both tremendously for your time today and for your insight and for your expertise. I think you hit on a lot of burning questions. So I appreciate, on behalf of our network, for the clarity. Thank you all to our attendees for joining, to our sponsors for your continued support. We really appreciate your presence. It's been quite a year. So we're wishing everybody a safe and healthy and happy holiday season. And we look forward to seeing everyone in the new year. Gentlemen, thanks again. Take care.
Thank you for having us.
Thanks for having us.
Bye-bye.